The ink wasn't even dry on the paperwork before Dale Harmon walked the lot a second time. 3 John Deere 4440s lined up in a row outside Midland Equipment in Tipton, Iowa. Green paint, still factory sharp. The salesman was already filling out the delivery schedule. Dale shook his hand twice, smiled wide, and said it loud enough for everyone nearby to hear. "Boys, this is how you build something." That was April 1980. 40 miles east, his younger brother Carl was standing in a dusty county livestock auction barn, waiting on a pen of black Angus to cycle through. 12 head. Bred heifers mostly. Nothing that would turn heads. He paid $480 a head, wrote a check from his operating account, and loaded them into a borrowed trailer by himself. Neither brother called the other that night. They didn't need to. They both knew what they'd done. This is a story about 2 decisions made in the same month, in the same farm economy, by 2 men who knew the same land and faced the same choices. One of them expanded. One of them didn't. And over the next 6 years, the American farm crisis would settle the question of which decision was right. Not through bad luck, not through drought or flood, but through the cold, mechanical logic of fixed costs, leverage, and cash flow. It wasn't about ambition. It was about structure. To understand why Dale's choice made complete sense in 1980, you have to understand what the previous decade had felt like. Commodity prices through the mid-70s had been strong. The 1972 Russian grain deal sent corn and soybean prices into territory nobody had seen before. Land values across the Midwest had doubled, then doubled again. Banks were lending aggressively, backed by collateral that seemed to rise every year. The USDA was telling farmers to plant fence row to fence row. Agriculture secretaries were giving speeches about feeding the world. Expansion wasn't reckless. It was practically patriotic. By 1980, a farmer who wasn't growing was considered quietly a farmer who was falling behind. Dale farmed 640 acres of rented and owned ground south of Tipton. He'd been farming the same operation his father left him, using 2 older tractors that were starting to cost more in maintenance than they were worth. The land was good. Yields were competitive. The problem was capacity. He couldn't get all his ground planted in the optimal window with what he had. A dealer told him the new 4440s would pay for themselves in efficiency. A banker told him land values would keep rising and the equipment collateral was solid. A neighbor told him 3 tractors meant he could take on another 160 acres of leased ground that was coming available. Every voice around Dale pointed the same direction. Up. So, he went up. 3 tractors at $42,000 each. Additional lease on 160 acres at $110 per acre per year. Total new annual fixed obligations, somewhere north of $44,000 before fuel, labor, or seed. He drove home from the dealership, and the fields looked bigger. Everything looked possible. Carl Harmon farmed 280 acres. He had 1 John Deere 4020, 12 years old and paid for. A grain bin, a small machine shed, and a farmhouse that needed a new roof. He had been watching the same expansion fever grip the county since 1976, and he had not moved with it. Not because he couldn't borrow. He could. The bank had offered him a line of credit twice that year alone. He just kept coming back to a single question that no one around him seemed to be asking. What happens to this payment schedule if grain prices drop 30%? Nobody wanted to run that math in 1980. The math was a wet blanket. But Carl ran it anyway, sitting at his kitchen table with a legal pad and a USDA price history he'd pulled from an extension bulletin. He ran it at $2, $50 corn. He ran it at $2, $0 corn. The numbers weren't survivable if you'd borrowed to expand. So instead of tractors, he bought cattle. 12 bred heifers wasn't a cattle operation by any serious standard. Carl knew that. But it was a different kind of asset than a tractor. A tractor throws off no income. It requires payments whether or not the crop price cooperates. Cattle, managed carefully, calve every year. Calves sell in the fall. Manure reduces fertilizer cost. A dry cow can be sold. The asset breathes. A financed tractor does not. Carl wasn't predicting the farm crisis. He was just avoiding a structure that required everything to go right. Cash flow decides. Through 1980 and into 1981, Dale's bet looked good, and it's worth being clear about this. The man worked hard. He planted his expanded acreage on schedule with the new equipment. Corn yields came in strong, 142 bushels per acre average, above county numbers. He paid his first installment on the tractors without strain. The 160 leased acres produced enough to nearly cover their own rent. At Christmas, he bought his wife a new truck. Carl, meanwhile, was watching his 12 heifers calve in February mud. He lost one calf to cold. He spent 3 nights in the barn that first winter. His first calf crop brought $380 a head at auction in October. A modest margin over feed cost, but a margin. The cattle were not making him rich. They were generating something steadier than excitement. They were generating cash in a year when grain was still priced high enough that Dale's margins looked better on paper. At a Farm Bureau meeting in November 1981, someone made a joke about Carl's little cattle hobby. Dale smiled but didn't pile on. He had too much respect for his brother, but others didn't hold back. "You've got 280 acres and a dozen cows," one man said. "You're farming like it's 1955. Carl didn't argue. He refilled his coffee and asked someone how their equipment payment was structured. He already knew the answer. Then the Federal Reserve moved. It hadn't been subtle. Paul Volcker had been signaling the tightening cycle since 1979, and by 1981, the prime rate hit 21.5%. This was not a modest adjustment. This was a structural shock to every variable rate farm loan in the country, and there were tens of thousands of them. Farmers who had borrowed at 12% were suddenly staring at rates they had never modeled, had never thought to model, because the previous 40 years hadn't required it. Dale's equipment loans were fixed rate, which gave him a partial buffer, but his operating line, the revolving credit he used for seed, fuel, and fertilizer every spring, was variable. His bank notified him in February 1982 that his operating rate was moving to 19%. On a $160,000 operating line, that was a different universe than the year before. He sat with that letter for a long time. Here is what made Dale's situation dangerous, and why it had nothing to do with his character or his work ethic. Fixed costs don't negotiate. The 3 tractor payments were going to come due whether corn hit 3 lao or 2 lao or 150. The lease on the additional 160 acres was going to come due whether the crop yielded 140 bushels or 90. Fixed obligations exist in a separate reality from commodity prices. They don't compress when the market compresses. They stay exactly where they are. And when the gap between what you earn and what you owe gets wide enough, the math becomes structural, not personal. It wasn't about ambition. It was about structure. Corn prices broke in 1982. A combination of the Soviet grain embargo, a strong dollar suppressing export demand, and a record domestic harvest pushed corn from $3.20 per bushel down to $2, $50 and falling. By mid-harvest, elevators in eastern Iowa were posting $2, $30. Dale's break-even on his expanded operation, accounting for rent, equipment, and operating interest, was somewhere around $2.65. He finished the 1982 harvest in the red, not catastrophically, not yet. He had some savings. He renegotiated his operating line with the bank, and they worked with him. Farmers with Dale's payment history were still considered viable borrowers in 1982. The bank wanted to extend, not foreclose. Foreclosure meant taking on depreciating equipment, and land that was now worth less than the outstanding loans. Everyone was trying to buy time. But time, as Dale was learning, cost money too. Every month, the payment clock ran. Every month, the interest accrued. Every month, the math got a little bit harder. Carl's cattle operation had grown quietly to 22 head by then. He'd kept his best heifers each year. His feed costs were partially offset by the corn he grew himself. He was feeding his own grain to his own cattle and capturing that value directly instead of selling at depressed cash prices. His fertilizer bill had dropped because the manure was working. He hadn't gotten rich, but he hadn't gone further into debt either. His operating line was $40,000, and in 1982 he'd drawn on less than half of it. The two brothers were, by the end of 1982, living in the same county, farming in the same market, but inhabiting completely different financial realities. 1983 arrived with a brief moment of hope. Corn prices ticked back up in the spring, touching $3,000 in April, on short covering and renewed export optimism. At the diner in Tipton, farmers who'd been quiet for a year started talking again. Maybe the worst was over. Maybe the expansion crowd had been right after all. Dale told a neighbor his cash flow was stabilizing. He wasn't lying. For 2 months, it looked like the pressure might ease. Carl watched this from across the table at a farm meeting and said nothing. He'd had a moment of doubt himself in that spring of 1983. Not regret, exactly, but an awareness that if corn had stayed at $3, tenon rates had eased, his cautious approach would have cost him real acreage and real growth. That's the honest truth about conservative financial decisions. They carry their own opportunity cost. You don't get to know what you gave up in the scenario that didn't happen. Would you have expanded? If every signal pointed up, if the bank was offering the money, if your neighbors were all doing it, what would you have done? By July, the corn rally had given back everything it gained. Prices dropped back through $2, $80, then $2, $60, then held a sickening plateau around $2, $40. The summer rally had been a head fake, and the farm economy, which had been holding its breath, exhaled into something that looked a lot like resignation. Dale's bank called a meeting in September 1983. He drove to the branch office in a clean shirt, which was its own kind of statement. The loan officer, a man named Brinker, who had personally approved Dale's equipment financing 3 years earlier, sat across a desk covered in spreadsheets and spoke in the careful, practiced tone of someone delivering news he'd delivered before. The operating line was tapped. The equipment appraisals had come back lower than the outstanding balances. Brinker used a phrase Dale would not forget. We need to see a path to liquidity. A path to liquidity. It was a bank phrase for a straightforward problem. The operation was spending more than it was taking in, and the gap was widening, not closing. Dale asked what options he had. Brinker laid them out. Sell 1 or 2 tractors and reduce capacity, renegotiate the lease and give back the 160 acres, find an off-farm income source, or refinance on longer terms at higher total cost. Every option meant the operation getting smaller. Every option meant admitting that 1980 had been a miscalculation. Dale drove home and sat in the machine shed for an hour. One of the new 4440s was parked against the wall. He'd barely used it in the fall harvest because fuel costs made running 3 tractors inefficient. The machine was 2 years old and had 600 hours on it, and it was becoming a liability in a way no one had told him was possible. Debt doesn't wait. By 1984, the farm liquidation cycle was accelerating across the Midwest. The Iowa State University Extension estimated that 1 in 4 farms with significant debt load was operating below its break-even cost. County sheriffs were posting auction notices with exhausting regularity. Equipment, combines, planters, tillage tools, was moving through liquidation sales at 40 cents on the dollar. Land that had appraised at $2,400 per acre in 1981 was selling for $100 or less. Dale sold one tractor privately in March 1984 for $28,000. He had paid $42,000 for it in 1980. He gave up the 160-acre lease that spring, walking away from the expansion he'd celebrated 4 years earlier. These moves bought him time, but they didn't change the underlying math. He was still carrying 2 equipment notes, still paying elevated interest on an operating line that the previous 2 harvest losses had nearly maxed out. The margin for error had gone to 0. A neighbor 3 miles east, a man who had expanded even more aggressively than Dale, who had financed a new grain dryer, 2 pivots, and 400 acres of leased ground in 1980, had his equipment repossessed in February 1984. Carl drove past the farm one morning and saw the bank's contractor loading a combine onto a flatbed. He didn't stop. There was nothing to say. Carl had 26 cows by then. He was selling 20 to 24 calves per year at a consistent margin. His grain operation was modest and entirely within his paid-for equipment's capacity. His total debt was $22,000. His annual payment obligation was $4,400. Even at $2, $20 corn, he was covering it. He wasn't comfortable, but he was solvent. In 1984, in eastern Iowa, those were not the same thing. The call came on a Tuesday morning in March 1985. Dale didn't say much in the first few minutes. Carl listened. The bank had issued formal default notice on the 2 remaining tractor loans. Brinker had been replaced by a workout officer, a different kind of banker, one who managed distressed assets rather than relationships. The workout officer had explained, without particular warmth, that the bank intended to schedule an auction of the equipment and that if the proceeds were insufficient to cover the outstanding balance, they would pursue a deficiency judgment against Dale's land. His land. The ground his father had farmed. The ground Dale had planned to leave to his own kids. Carl drove over that evening. They sat at Dale's kitchen table, the same table where Dale had laid out expansion plans in 1979, and worked through the numbers together. There were limited options. The land carried a modest mortgage but had equity, or it did in 1979. Now, with values down 50% from peak, the equity cushion was thin. If the bank moved against the land, Dale might come out with very little. Carl made an offer that night. He would buy Dale's 240 acres of owned ground at a price that covered the outstanding debt, allowed Dale to avoid the deficiency judgment, and kept the land in the family rather than at a sheriff's auction. The price was $850 per acre, below what it would have brought in 1980 by a significant margin, but honest to the current market. Dale would be able to clear his debt and keep farming as a cash tenant on the same ground for the first 3 years. Neither of them said much after the number was on the table. Where did Carl have the money? He didn't have it in cash, but his 26-cow herd represented liquid assets he could partially liquidate. His operating line was clean. His father's credit union, which still operated on relationships more than spreadsheets, would extend him a straightforward land purchase loan at a rate that reflected his clean payment history. Carl had options because he had kept his obligations small. He had kept his obligations small because he had not confused the appearance of growth with the reality of solvency. He had never believed that looking bigger was the same as being stable. Cash flow decides. It had decided this. The equipment auction on Dale's farm was held in April 1985. The 2 remaining 4440s sold for $19,000 each, less than half their purchase price. The operating line balance was reduced, the workout officer closed his file, and Dale's debt was settled at a level he could survive. The land transfer to Carl, recorded at the county courthouse, without ceremony. In May of that year, Dale planted his first crop as a tenant on the ground he had grown up farming. He used Carl's old 4020, which Carl had running well and offered without condition. Dale had a cash operating line of $35,000, no equipment debt, and for the first time in 5 years, a payment structure he could actually service. He told Carl one evening that the hardest part wasn't losing the land. The hardest part was understanding that nothing had gone wrong in any dramatic way. There'd been no flood, no crop failure, no catastrophic event he could point to. The farm had been stressed to death by its own fixed costs in a market that had moved against it by 20%. 20%. In almost any other business, a 20% revenue decline would be manageable, recoverable. In a business with 80% fixed cost ratios and thin equity margins, it was fatal. Dale understood now what Carl had understood in 1980. Leverage magnifies both gains and losses with complete indifference to how hard you work. The market doesn't grade effort. It settles accounts. It wasn't about ambition. It was about structure. By 1986, Carl owned 520 acres, his original 280 plus Dale's 240. He was running 30 cows. His grain operation had expanded modestly with the land, but within the capacity of equipment he had gradually upgraded with cash rather than credit. His total debt-to-asset ratio was 18%. In a county where the average was pushing 60% among farms that had survived, that number was almost remarkable. He was not a wealthy man by any ordinary measure. The land was still worth less than it had been 5 years before. The cattle market was cyclical and would have its own difficult years ahead. Carl had no illusions that he had discovered a formula that guaranteed anything. But he was farming his own ground on his own terms, with cash flow that covered its obligations and a financial structure that could absorb a bad year without collapsing. That was the quiet version of success, the version that doesn't attract attention until everything around it has failed. The Iowa farm crisis claimed roughly 14,000 farms between 1981 and 1987. Most of them weren't lost because their farmers were bad at farming. Most of them were lost because their debt structure required conditions, stable rates, stable prices, rising land values that had been present for a decade, and then, without ceremony, were not. The market shifted. The fixed costs did not. That gap, measured in dollars and time, is what a sheriff's auction looks like from the inside. If you're watching this story and asking whether Carl was just lucky, that's the right question to ask. The answer is that he had better information than luck. He ran the downside scenario in 1979 when expansion fever made that feel pessimistic. He chose assets with flexible cost structures over assets with fixed ones. He kept his obligations sized to his worst reasonable year, not his best. That's not luck. That's discipline applied before the crisis arrives, when it still feels optional. The question underneath this story isn't really about tractors or cattle or 1980. It's about what you believe financial structure is for. If you believe structure is for accelerating in good conditions, you optimize for leverage. If you believe structure is for surviving bad conditions, you optimize for liquidity. Most of us don't consciously choose. We get swept along by what the people around us are doing, by what feels like the obvious move, by what the bank is offering and the neighbor is buying. Dale Harmon was not a reckless man. He made a rational decision in a culture that validated that decision at every turn. The farm crisis didn't separate reckless farmers from careful ones. It separated leveraged capital structures from resilient ones, and it did so with the impersonal efficiency of a market that had no opinion about effort or intent. Debt doesn't wait. Cash flow decides. And in the long run, structure outlasts ambition every single time. If you want more stories about the financial decisions that shaped American agriculture, the ones that held and the ones that didn't, subscribe. These stories aren't history lessons. They're frameworks that still apply every time someone signs a loan for an asset they need a perfect market to service. And if this story reminds you of a decision you're facing now, or one someone in your family made, leave it in the comments. The best financial thinking usually happens in conversations that start with, "What would have happened if the market had moved the other way?"